Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me today Dr. Robert McHugh. I'm conducting an interview with Dr. McHugh because I believe we are very near a momentous period in American history and the history of markets that have been caused by decades of monetary and political abuse of what was once a prosperous free market capitalist economy in America. Let me try to explain where I'm coming from and why I think it is so important you hear what Dr. McHugh has to tell you today. In 1967, I had a college professor named Dr. Peyton Yoder. He was at a small Mennonite college at Heston, Kansas, called Heston College. Dr. Yoder was convinced that there was a correlation between the debasing of a currency and the demise of a nation's work ethic and its morality. Well, now, I'm quite a bit older. I'm 67 now. As such, I recall the presidency of Dwight David Eisenhower, who warned of the military-industrial complex. President Eisenhower, by the way, was the last president to have the gold supply in America audited. I recall the presidency of John Kennedy, who warned of the dangers to our liberty of secret societies that gain control of our government. And I remember very vividly the speech that Richard Nixon made on Sunday, August 14, 1971, when he removed gold from the backing of the U.S. dollar in what he said 43 years ago would be only a temporary policy. What followed that fateful August 15, 1971 enactment of gold's detachment from the dollar was the start of a cancerous monetary creation and the big lies that it fostered. The biggest lie of all was that we can have greater living standards not by working harder and saving more, but by working less hard and spending more and taking on more debt. In my view, believing that big lie our governments tells us that you can have something for nothing not only led us astray financially, but morally, spiritually, and socially. The relationships that began to deteriorate as a result, I believe, of that false assumption. And with that came the demise of the very basic building blocks of a healthy society, namely the family. With the breakdown of the family has come a decline in the educational standards, for example, such that the U.S. now lags most of all the advanced nations in terms of its educational success. Never do the politicians call for a re-examination of the real causes of these problems, namely a breakdown in the moral fiber of the American people caused by an immoral monetary system. Nor do the Federal Reserve officials ever seriously look at the real cause of our economic malaise, namely a fraudulent currency that is created out of nothing and then used to foster that big lie that we can have something for nothing, not to mention used to reallocate wealth from those who create it to those who control it, namely the politicians and the bankers. Our fraudulent monetary system has been in place so long now that most people don't have the foggiest idea that the premise of our policies are wrong to begin with, and as such, we have allowed stress to build up in our financial and political system to the point where a massive breakdown of our political and economic system is now imminent. But ignorance is no bliss, any more than if you were driving over a bridge that was about to fall down due to the stresses and cracks in that bridge that occurred over years of abuse and misuse. To help us visualize the stress fractures of our markets and economy, I have invited Dr. McHugh to pass along his insights and warnings to you. In my view, the enabler of most of the problems we have now in our markets and in our political system was the debasement of our monetary system, starting with Franklin Delano Roosevelt in the 1930s when he detached gold from the monetary system in the United States, and then after that with President Nixon's demolition of the gold standard internationally in August 15, 1971. But there is something even more basic, in my view, that underlies the reason we went off the gold standard in the first place, which I will address in a segment following my discussion with Dr. McHugh. So let me introduce to you Dr. Robert McHugh, who has been with us several times in the past on Turning Hard Times into Good Times. Dr. McHugh is President and CEO of Mainline Investors, Inc., founded in 2003 to provide technical market forecasts for stock and precious metals markets, offering trading education and a platinum trading service for subscribers interested in managing a speculative segment of their total portfolio to achieve above average returns. And you can go to, and I would really suggest that all of you take this website down. It's Technical Indicator Index, technicalindicatorindex.com. It's where you should go to catch up with Dr. McHugh. He is the author of a book called The Coming Economic Ice Age, which I have in my hands now. I've read through it. It's a compelling read if you really try to understand what is going on in the markets, why things have become so volatile. I think you'll find an awful lot of those answers right there in The Coming Economic Ice Age. So, welcome, Dr. McHugh. It's really good to have you with me again.
Thanks, Jay. It's always a pleasure.
Always a pleasure to talk to you as well. Before we get started with our discussion, I would like to, my listeners, again, I would just like them to jot down technicalindicatorindex.com, technicalindicatorindex.com. I am a subscriber to a service, part of what Dr. McHugh offers. It's almost a daily service. Almost every day, I think you write something, don't you, Robert?
Pretty much every day, yes. Once on the weekend and every day during the week. Yeah.
And the weekend really is a very comprehensive review of where things stand, but lots of timely information. And I got to tell you, after a day like today, and we're recording this on the 15th, Wednesday, the 15th of October. It was quite a day, with the Dow down some 400 points at one point. And it's just a very uneasy feeling that you have as you watch this market, unless you're prepared for it. In your book, Dr. McHugh, you talked about, well, it was published last year, actually. I think about this time last year, was it, in 2013?
That's right. We put it out about this time last year, and we said watch out for late 2014 and into 2015. Well,
it's quite prescient, it seems. You talked about the megaphone formation in the Dow and other major indexes in your book, and that these are very bearish formations for the stock market. And you've chosen to name those formations, though. You've chosen a name of your own. You call it the jaws of death. Can you describe for our listeners what the megaphone formation is and why you have chosen to rename it the jaws of death?
Sure, Jay. This is a pattern that appears at tops of all the major bull runs over the last century. It is a formation where you draw a trend line along the top, connecting the highs of the previous several periods, and then draw a trend line connecting the bottoms of several prior declines. And the symmetry is identical up and down. It's like a perfect opposite mirror slope up and down, and they widen as you go further into time. So it looks like a shark with its jaws wide open. Mm-hmm. And the reason I call it the jaws of death is because inevitably at the end of these patterns, the stock market has a violent decline, and we usually end up with a severe recession, and quite often we end up almost every time with a world war.
Wow. Well, you've given several examples in your book of megaphone or jaws of death formations, and they didn't all end in world wars. A number of them were. I'm just trying to think what some of the other dates were. For example, 1929. I guess that's an example of one that did end in a world war about that time. But we've had wars. We've had ongoing wars, it seems, in the United States. But it seems to be there were some other smaller ones that didn't really end in world wars, but were nonetheless a lot, increased activities in wars. For example, I've jotted some of these dates down. If I understood what you said in your book, 1929, 1957, 1965, and then you touched 1972, 73, 86, and 87, 1998, 1999, and 2007. Were those all periods of time when this jaws of death or megaphone formation, at least, was evident in the equity markets?
Yes, that's exactly right. And almost every one of those had some type of a world conflict. Vietnam, Korean, the Iraqi wars,
right.
1 and 2. So there is a definite one-to-one correlation with wars. They may not be called World War I or World War II, but they have involved a lot of nations and created a lot of turmoil throughout the world. Each time these patterns show up, it's amazing when these things come, because they reflect the psychology of mankind at a particular point in time.
Uh-huh.
That's why they're accurate. That's why they work. They're measuring mankind psychology. It turns very negative, very conflict-oriented, very unsafe, unstable, very messed up, just in an easy way to say it.
Sure. Well, if I look at the at your chart that you show on page 32 of your book, The Coming Economic Ice Age, I look at the Dow, chart of the Dow, and you see, violent decline in 2000, from 2000 to 2002. Then, of course, the famous one in 2008, 2009. And then, of course, we have new highs. We've had new highs during that period of time. So it seems to me that you have increased volatility over a longer period of time. And I guess this is suggesting instability in the markets, right?
Yes. And I think the thing that's most fearsome about the current jaws of death pattern is this is a massive pattern that's been going on for 25 years, and it contains two other jaws of death patterns that were smaller inside of it as component patterns while this was going on.
Uh-huh.
This is the largest pattern I've ever seen. It's larger than anything we've seen in the last 125 years. I took it back to 1900. And it's just the largest we've ever seen. And the size of it implies a decline economically on a scale larger than any we've seen, and I fear a war larger than we've seen. It's the psychological measurement here is such that there's danger coming at us from all directions. The mindset of mankind now is very negative, very bearish, and bad things are coming and will be a consequence starting, I think, probably right now they're starting.
We see, of course, increased turmoil and problems of all kinds, Ebola breaking out, ISIS, increased wars, a new conflict with Russia, it seems, again, increased hostility with China to a certain extent, I would say. Chinese instabilities in their economy and a decline in the growth of that economy. Japan's in bad shape. Europe is having lots of trouble. So it does seem like there's increasing tensions and problems around the world. One of the things you talked about I find very interesting, and you talk about it frequently and keep your subscribers up to date, is something called the Hindenburg Omen. Can you tell our listeners what the Hindenburg Omen is and why is that so ominous?
Oh, sure, Jay. The Hindenburg Omen is an independent measure of the underlying health of the stock market at any particular point in time. It has appeared before every single stock market crash over the past 125 years. Over the past 35 years.
Mm-hmm.
I went back to 1987 with it. It is a condition in the market that where the number of new highs and the number of new lows are both simultaneously above a threshold at the same time that the majority of stocks are declining, at the same time the 10-week moving average is rising. And what this is it's an uncertainty in the market that is so clear and so dramatic that it can only lead to trouble. Or let's put it this way, it has a high risk of leading to trouble. Mm-hmm. Not every Hindenburg Omen results in a crash. About 1 out of every 4 does. But the ones that did not result in a crash, 70% of the time you're going to get a decline of something like we're seeing right now, 5 to 10%. Mm-hmm. So it does signal that for a healthy market, you have to have everybody on board that it's going up or everybody on board that it's going down. But when there's a dramatic fight going on, of whether it's going up or down in a trend, that's when you have a very unhealthy market because you lack clarity. Mm-hmm. And lacking clarity is one of the most negative aspects, characteristics of a stock market for it to continue higher. It really simply can't.
So you might say that it becomes a very emotional market, one in which people are gripped with fear on the one hand, and others are optimistic and hopeful. You have a divergence, essentially, of the attitudes and emotions of investors?
Yes.
Mm-hmm.
And that has appeared before all the crashes, or I call it crash 15%. So there have been several 15% declines since 1987 that people probably don't remember that the media didn't talk that much about.
Sure.
But this element appeared before every single one of them, except one. In August of 1911, we had a 1 week 17% decline. The HO was not there at that point.
Mm-hmm.
But of the other, what I call crashes, it showed up every time. And we got one in September 19th of this year. We had another official Hindenburg omen. And the very next day, the stock market started declining in what now is it's about a 9% decline so far.
Okay.
From September 19th.
So we have a little ways to go before you would officially label it as a crash. I believe, correct me if you're wrong, but you see the highs of for this equity market, at least for the Dow, of September 19th?
I do. At this point, I believe that may be the top for the market for a long, long time. And the reason I say that is because the jaws of death pattern looks like it completed at that date, and where the price of the stock market reached the top boundary line. And then we had a rising bearish wedge, what I call a wedge, which is a subs pattern underneath the jaws of death, which is a termination top pattern, and that completed at the exact same time around September 19th. And stocks have since dropped dramatically below the bottom boundary of that pattern, which is a very bearish development. Stocks have fallen below their 200-day moving average now, which is a very bearish development. And so we have a clear signal from technical analysis that this market has a long way to go in just the first leg of what I believe will be a massive bear market. Mm-hmm. I think we could see the industrials down to 14,750 over the next 6 months, and then maybe we'll see a counter trend rally. But eventually, I see the Dow dropping all the way down below 5,000, and the S&P 500 dropping well below 500.
Wow!
By the time this whole thing is done, many years from now.
Okay, so this is a multi-year thing. I guess, though, you're not certain whether it's going to be, I remember reading something just recently, a short-term or a relatively quick decline to those levels would be several years, though, I believe, in your view.
I think it's going to take time because I think the Federal Reserve and the market makers, Wall Street, will fight tooth and nail to prop this market up and keep it as high as possible. See, many years ago, the government was illegal for them to buy stocks. Well, apparently that doesn't matter anymore, and the Fed, through the Plunge Protection Team, just comes in and buys futures and stocks through their surrogates, Wall Street. And, of course, we know that they just sent $5 trillion of cash to Wall Street in order to do many things, including prop up the stock market. But the problem is they can only buy so much, and the market is so heavy, and bids are so scarce, and the world confidence is dropping so fast, and so much strife is occurring in all phases of life right now and all around the world that are really irreversible in many cases, that I don't see a clear way out of this for many, many years. I think we've got a runaway freight train that's just getting started now.
Yeah. Well, 1987, I believe, is when the Plunge Protection Team started doing that. When during the Reagan years, during the '87 crash or thereafter, is when I believe, Robert, it's my understanding, that's when the government started buying and started manipulating the markets like that. 1987. So we have, of course, this huge amount of debt too. I mean, even if for those of us of a more fundamental orientation, we look at the debt that is growing exponentially, cannot be repaid, that it just seems to me that there's at some point along the way, there's all engineers know that systems have their limits, and it would seem to me that there is some limit. Clearly there's some limit. It seems to me what you are signaling to your subscribers is that we're getting very close to that breaking point. I
believe we are. I do. 100 trillion of unfunded liabilities, that's a trillion with a T. I mean, it's insane. And here's the thing, that people may not be aware of what the Fed is doing, but the Fed is tightening the money supply right now at the very worst time possible. The way they've been saying it in the media is that they've stopped QE2 or QE3, that they're no longer buying $10 billion of bond every month.
Mm-hmm.
The truth of the matter is they're actually pulling money out of the economy right now aggressively by doing nothing. Because the Fed holds $5 trillion of bonds and securities that they've acquired over the past 5-10 years, they are owed money from corporations, municipalities, and federal government in the economy. If you put a wall up and separate the economy versus the Fed, if it's in the Fed, it's not part of the economy. If it's outside the Fed, it is part of the economy.
Mm-hmm.
Just by having bonds that are maturing, just by being owed coupon payments on those bonds, money must flow from the economy, government agencies and the corporations and the municipalities and the mortgage-backed securities, the issuers of these bonds. They have to send money to the Fed, just as a matter of these instruments rolling off the Fed's balance sheet through maturities or coupon payments due because interest is due on these instruments. That's all. That's an enormous amount of cash flowing from the economy to the Fed, and that is pulling money out of the economy. That is a tightening of our monetary supply at the very worst possible time. It's a gigantic mistake. It's a consequence of the QE3 programs. They had 3 of them. And as a consequence, they've kicked the can down the road with these QE programs. Well, now it's time to pay the piper.
Mm-hmm.
What are you going to do with all these bonds if you're the Federal Reserve? The only thing you could possibly do is forgive the debt so that the cash doesn't come from the issuers over to the Fed in order to stop the money supply from leaving the economy and heading to the Fed. They're not going to do that yet. They may do that down the road. They're not going to do that yet. So we have this enormous monetary tightening going on that nobody's talking about.
Yeah. In fact, we've had Richard Duncan, a former economist of the at the IMF, on this show, and he's insisting that the Fed will, in fact, not be able to continue tightening. And I wasn't aware, actually, Robert, that the Fed was sort of through the back door tightening as they are. You know, there's all kinds of talk about they're going to phase out quantitative easing. Tapering is the terminology they use. But I wasn't aware that it was that restrictive already. So that really could account for some of the reasons that we're starting to see this pullback in the equity market, I suppose.
I do believe that.
Yeah. In addition, you know, you are best known, I think, probably for your Elliott wave analysis, and I might just mention also that another of your fellow Elliott wave practitioners, Robert Prechter, also has labeled September 19th as the high for a long time to come, and Prechter is actually looking at something, unless he's come up with something different recently, at a sub 1,000 on the Dow. So you're quite bullish compared to him, but I don't know that a sub 5,000 will look very bullish to very many people, and an awful lot of pain that is to come as a result of that. So you use, you have this jaws of death, which to me in some ways is really sort of goes along with the Hindenburg Omen and some of these other technical tools that you use, Elliott Wave, of course. I'd like to ask you a little about some more of the tools that you use, and perhaps the one that is most intriguing to me is what you call your Plunge Protection Team Indicator. I think you also refer to it sometimes as your Demand Power Supply Pressure Gauge. The whole notion of our government manipulating markets is an anathema to the fundamentals of free market economics, and you have a way of measuring how much the Plunge Protection Team is buying in the stock market to keep it from falling. Could you talk a little bit about your Plunge Protection Team gauge?
Well, what I do is I measure demand and supply every day, so I get a gauge on how powerful the day's move was. Was there a lot of demand on, let's say the market rallies, was demand really strong, or was it a weak rally that maybe a few stocks pushed the market up, but it was a weak rally? Was it strong or weak? So I measure the demand and supply every day, and basic economics 101, demand and supply, equal out at the equilibrium price. Somebody sells, somebody else has to buy, and that's an efficient market has a lot of buyers, a lot of sellers, and they agree at the end of the day on the price of the market. So everybody's happy, and it's an efficient market. But when I see in my measurements that demand power is substantially moving, they're supposed to move in the opposite direction. And when demand power's opposite move is different than supply pressure's move. In other words, if demand power falls 5, supply pressure should rise 5. That's a balanced market that's efficient. When I see demand power, let's say, rise 5 points and supply pressure drop 19 points, that's an imbalanced, inefficient market. That tells me that the market was not able to provide bids for all the selling that went on. The large institutional investors, the mom and pops, the brokerage firms, the daily buyers of the market weren't there. And that in order for the market to settle, somebody had to step in and provide bids at the closing price, or else we would have had a crash.
Right.
Because there would have been no bids and prices would have had to continue to drop.
Right.
So what I do is I measure this every day, and when I see this imbalance, it means that the plunge protection team had to come in and buy the market to establish that day's price and prevent an all-out crash. And we see a lot of that going on in the last month. There's not a lot of bids out there from the market. People are afraid. They're not buying. So the plunge protection team has been coming in with both hands and doing a lot of the buying right now.
Yeah, I remember the other day, I think you mentioned to your subscribers that it looked like almost half of the buying was coming in from the PPT. And so this is the kind of thing that I find makes your service so valuable. To have that kind of information is very, very valuable. It helps you sort of understand what position you should take or what the probabilities are of the market going in one direction or another. You talk about the market being heavy. I guess that's what you're talking about. If the supply pressure is 19 and the demand pressure or the demand power is 5, then obviously that's an out-of-balance market, and certainly it's a heavy market that suggests downward pressure, and that's what I guess what you've been seeing. So after today, you'll take, after we finish at some point in time here, I guess you'll probably look at today's markets and come up with some number for your subscribers.
That's right. We'll measure supply and demand again tonight and draw a conclusion of what kind of a underlying market we had. Do we have the sufficient bids for an efficient market, or was this another day where the government was buying it hard to prevent an all-out, flat-out crash, which would be my suspicion based upon what we saw today.
Yeah, and I know today the market turned fairly abruptly late in the afternoon, or after lunch anyway, in which Janet Yellen was supposed to have made some statement about the economy still being strong, which I don't believe. I don't buy that one at all. But nonetheless, that's the propaganda that we still have 3% growth, or we're going to have it, and the market's turned around. And then I would be interested in knowing, and I'll be looking forward to your missive that comes out again today to see what conclusions you've come to with that plunge protection team measure. You look at other things like trend lines, moving averages. You look at something called the 5-8 turn date and the Bradley turn dates. Could you just take a minute perhaps for our listeners, describe what those two turn dates are and what do they mean?
Okay, the 5-8 turn date is something I came up with about 10, 12 years ago. And what I noticed was that major tops and bottoms in the stock market, where you get significant trend reversals, occur on a regular basis. A Fibonacci percentage of time between each other. I went all the way back to 2007, and phi is the number 0.618, and it's a universal number. It actually is an infinite number. You can never solve it. It's like pi, and it is a key number for all. Man's body has been designed with phi.
Interesting.
Our most pleasing architectural structures have the one side of this. If you're looking at a rectangle, the length will be 61.8%. The depth will be 38.2%. That's the most pleasing structure to look at or a picture.
That's fascinating.
If you look at the solar system and the universe, God has put a phi relationship in so much of what we see in physics. And so it's also true in the markets. We're finding out that tops and bottoms occur a phi percentage of time from each other. Not every turn, and not the minor ones, or if they do, I don't measure those, but the larger ones do. And so what I do is I calculate the scheduled 5-8 turns each year. At the end of the year, I put out a schedule of the 5 or 6 major turns we can expect the next year off of this 5-date analysis. And it's remarkable how close these dates are to turn dates. And the same thing with the Bradley model, only that's a completely independent and totally different view of turns. And that was created by Donald Bradley, and that looks at the astrological relationships of the planets and the stars, and does a comprehensive calculation because they've proven that the psychology of mankind is moved by the gravitational forces of the planets and things of this nature. Mm-hmm. And so, using the Bradley model, they come up with the 5 or 6 key market turn dates that are likely each year, and then I present these dates to my subscribers so they can get a feel for what is a possible turn date coming where you can expect a reversal of the current trend. And you never know quite if it's an up or down move until you get close to it, because whatever trend is going in, it'll reverse, but you don't know exactly what that trend is until you get closer to the actual turn. But what you can do is be aware of these dates and kind of say, okay, we got a turn date coming, let's be careful here. This trend that we're seeing now may not continue forever. Looks like we're going to have whether it'll be a corrective reversal or a new permanent trend reversal. There'll probably be some kind of a reversal, and they're usually accurate to within a week or so. And I'd say they're probably 90% of them work. You know, there's always the 10% that doesn't, but it's a fascinating additional indicator to kind of take a peek at.
Well, I hope our listeners are getting a sense that Dr. McHugh does a very thorough job with a lot of different indicators, and I think that you do a remarkable job of keeping objective about these things, Robert, and I really appreciate your work. I think you do a remarkable job. Bearish divergences such as advanced declines as well you look at, I know. And anyway, it's just so many things that you talk about, and you cover so many bases. I know that you work extremely hard, and I'm very appreciative for all you do. I have to ask you, you see this jaws of death? I think you see it in the Dow, you see it in the NASDAQ and the S&P, all three of the major indices?
See it in the S&P and the Dow, and the NASDAQ has something a little bit different, but just has a rising bearish wedge, which is just as bad.
Yeah. How do the technicals look from your point of view? Do you watch the Asian markets, the European markets, and some of those as well, the major indices for any of those?
Oh yeah, we have a jaws of death in the European stocks 5E index. The largest companies in Europe are looking at one of these jaws of death as well and forecasting a major decline. So we're seeing internationally a lot of troublesome patterns as well coming simultaneously with what we see in the United States. We think we're headed for a worldwide severe recession. I think it'll be a depression. I think it's starting now. I think it's going to continue to get worse. And some of the things that we thought were never possible will happen. And it's sad. It's frightening. I warned everybody about a year ago so people could do things to prepare and do the best they can. And with God's grace, we get through it, But it's not going to be a pleasant period of time we're heading into. I wish I could say it was going to be great, but it's not. Based upon the indicators I see, the patterns I see, and the measurement of the psychology of mankind that we're watching right now.
Right. Well, certainly, I think difficult times sometimes can either bring out the best or the worst in people, and I think that sometimes difficult times bring a spiritual awakening and a reconnection sometimes with people's faith and help them understand their origins and why they're here. So I think it can also be a blessing on one level, although it's as you say, not going to be very pleasant. One of the things that we try to do on this show, and I do in my newsletter, and I know you do as well, you do follow the precious metals. How does gold look to you now?
Well, I think gold will be a safe haven. It'll head higher eventually. I think what's going to happen is the Fed will reverse course and start printing money like crazy when it becomes evident that the sky is falling. And when that happens, gold will just skyrocket. Gold, I think, will trudge a little bit higher in the short run, and then once the Fed changes its tightening policy and just starts rolling out the printing press again, because that's the only thing we know what to do, gold will fly high, very high.
Do you look at silver? I'm sorry, go ahead.
Yes, I think the same thing. I think the same thing for silver too, both precious metals, because I think that what will happen too is the currencies, fiat currencies, will become under enormous risk because they print so much of it. You know, and I honestly think the only way out of our unfunded trillions of dollars of unfunded liabilities, I think at some point there will have to be a currency change. At some point that they will have no choice but to establish a brand new currency with a new relationship to debt, to try to get rid of the debts that way, to you know, basically wipe them off, erase them. And at that point, gold will be very, very precious to have, and should be a tremendous medium of exchange for the new currency, whatever they come up with.
Yeah. Well, certainly somebody makes the point on this show, David Jensen talks frequently about how the paper markets are exactly that. In London and New York, the paper gold markets are massive futures markets, and only about 1% gets settled in actual bullion. But in fact, the Shanghai market is 100% bullion market, in which nothing but gold is exchanged. There they have to deposit their gold before they're allowed to sell it. So it's a more honest market, I would say. But we see what you call the plunge protection team, I suspect, are some of the people that are coming in and driving the price of gold down exactly at a time when it seems it should be going in the other direction. But, you know, as you say, there are limits to what the plunge protection team can do, right? So speaking of limits, Robert, I'd like to know then, how do you view the Treasury markets? Because there have been people, you know, so many people I've known, so many of my friends, people that are hard money, honest money orientated people, who have been predicting a decline in the Treasury markets for some time. The U.S. Treasury market just keeps getting stronger. Every time we have declining markets, equity markets, money flows into Treasuries. The dollar has gotten stronger recently relative to other currencies. So we see money flowing into the U.S. Treasuries. But do your charts tell you anything about U.S. Treasuries?
Yeah, they say that the Treasury yields are going down, and that the price of Treasuries will go higher. This is a key safe haven, and once the Fed starts throwing money back at the economy after they realize this thing is going down the chute, they will have to buy more bonds and monetize the United States debt, and that's a huge buyer for bonds, and that will force interest rates lower and prices higher. And, you know, and that's going to be one of their traditional tools to try to re-stimulate the economy when they realize we're headed for a deep recession. You know, they're going to buy bonds, push down interest rates, and I am not expecting interest rates to rise. I am not.
But then when the confidence is lost in the currency, that might change, I would think.
I don't think it will, because Treasuries will be seen as a huge safe haven internationally. As everything's falling apart internationally, people will flock to buy the U.S. Treasury. We still have the strongest military on earth. We guarantee the Treasuries. It's an instrument of the government itself, whereas the dollar is not. And so I honestly think that the Treasuries could diverge with the dollar. The dollar could drop, and Treasury prices could rise at the same time. Very
interesting. Yeah, that's certainly a different view than I've heard from many other people, but I want to thank you for that. Robert, I know that you and I, we share a Christian worldview. From that vantage point, how do you view what seems to be an increasingly troubled world? Do you really think this is different this time? You know, we go back through history all the way into the Old Testament days before Christ, and there were an awful lot of horrible things happening throughout history. Do you think this could be something different this time?
My faith and my studies of the Bible tell me that, yes, this could be a difference this time. One of the big differences this time, and I'm getting into a little bit of Bible study here, is the book of Revelation talks about end times tribulation period coming. Within one generation of the reuniting of Israel as a nation. That happened in 1948. In Psalms, it defines a generation of 70 to 80 years. You add 80 years on to 1948, you get to 2028. You add 7 years, you get to 2018. The Bible describes that just prior to the end of that period, there'd be a tribulation period of 7 years, and that a lot of the things that we're seeing, I believe, in seeding in the infancy of what we're looking at right now, seem to tie in very clearly with what the Bible describes as signs of the times of a dramatic period of tribulation for the entire world that the likes has never been seen. And I just feel as though that's possibly what we're looking at right now. It's just, my belief, my feeling based upon my studies, but I'm not by any means an expert in the Bible, but that's what I see. I don't know.
Sure.
What you can say.
Well, I think anyway you said that's a possibility. You're not saying that you know for sure. In fact, I think Scriptures warns us that we're not to know the exact time of the return of Christ. So, but I appreciate that. I can see what you're saying. It makes a lot of sense. It could very well be the case. So I really want to thank you for your excellent work, Robert. I really appreciate reading your material, especially when times get troubled like this. I think your service is so important, and this is why, again, I would tell people to go to technicalindicatorindex.com. And before I let you go, just give our listeners a brief review of what you offer. Now, the service that I subscribe to, I think I signed up for 6 months this time. It's a very reasonably priced service, and then you have another service that you provide it's more expensive. It's for people that are trading more actively, right? Could you just explain the two levels of service that you provide?
Sure. People can get in for 30 days for free in the standard subscription, which is not a trading service. It's the one you subscribe to, where I give comprehensive daily reports and the expanded weekend report with a lot of the indicators and commentary charts and so on of what's going on in the markets. It's not really geared for trading. As part of that service, what I do provide is a mock $500,000 conservative investment portfolio model where I present a scenario that should benefit in preserving wealth for that particular economic time that I see. And it's more of an educational offering where people can just kind of take a look at it and consider what I'm doing and then make their own decision as to whether they want to take advantage of anything I'm doing or not. Then I have within a conservative portfolio, I say that 5 to 10% of a person's total portfolio, let's say 90% should be in something conservative, safe, and wealth protective. And then I say 5 to 10%, it's okay to speculate, be aggressive, to try to trade the up and down moves of the market, to try to enhance overall returns for the entire portfolio by just putting a few dollars at risk that have an opportunity to generate extraordinary profits, so that at the end of the day, that 5 to 10% may be contributing more to the overall portfolio's return than the other 90%, and at the same time you preserve most of your wealth. And that's the Platinum Trading Program. It's just simply for people that are interested in speculative, aggressive, market timing trades, usually use options because they have leverage in the market, and it's an educational tool. I mean, it's not telling people what to do or not do. It's showing them what my thinking is on a trade, what trade I'm doing at that time in speculation, something I feel has a potential to produce a return that is extraordinary. And, of course, there's risk with that. There's losses are possible, so I recommend people limit each investment, each trade they make to a certain amount of money that they can afford to lose. And hopefully at the end of the day, there are more winners than losers, and then the overall speculative portion has contributed some nice earnings to the overall conservative portfolio.
Yeah. Well, I think that certainly makes a lot of sense, and I know that you also provide updates and let your subscribers know how those recommendations are doing too, and you do that on an ongoing basis. I might just say in closing that I have not signed up for that more expensive service, but I have found your basic service to be very, very helpful to me, Robert, over the last couple of weeks. In earning some profits on the short side of the market through some ETFs, just in general to have a sense of which direction the market is going. It's worked out very well for me. And I would tell my listeners, again, it's technicalindicatorindex.com. Go there to learn more about Robert, and you heard that you can actually get a trial subscription for free for 30 days. My sense is that if you take Robert up on that, more than likely you're going to want to continue with his service, because especially at times like this when things are really getting very, very tenuous and very troubling in many ways in the market. So I want to thank you very much, Robert, for being with me again today, for sharing your time. I know your time is very precious. You're courageous. You're a very courageous person in sharing your faith and honesty, and I really appreciate it. Thank you very much for being with us once again.
Well, I appreciate you too, Jay. Thanks for all you're doing with your listeners, and I appreciate your show and the wonderful message you bring of truth, to listeners. Because in this day and age, it's so hard to get our arms around the truth. There's so much spins thrown at us that we just want to know the score so we can make the appropriate adjustments for our personal lives. And I thank you for what you do in that area.
Amen to all that. Thank you very much, Robert, and look forward to talking to you again sometime in the not-too-distant future. Thank you so much.